Vanguard's life strategy funds are one of the most popular fund ranges in the world. And it's easy to see why. They make investing super simple, and all you need to do is pick one of their 5 funds, and that's it, away you go. But there's a slight problem. What happens when you get closer to retirement? Should you be reducing your risk? And when should you do it? Well, again, Vanguard is ahead of the game here, and they have created a fund range that does all of this for you. They're retirement target funds. But have they really solved the problem? Well, in today's video, we're going to find out. And we're going to be exploring exactly how you should be thinking about risk as you get closer to retirement. Hello and welcome back to the channel. For anyone new here, hi, my name is James, and this is a place where you can learn everything that you need to know to feel confident in the financial decisions that you are making. Everything from the absolute basics all the way up to advanced strategies that are being used by financial professionals like me. Now, I've previously made 2 videos on Vanguard life strategy funds, the first of which was designed to help you understand how they work and how to identify the right fund for you. In that video, I explained that the reason why these funds are so popular is that all you need to do is invest in one of these funds and you automatically get access to a globally diversified portfolio of stocks and bonds. And in my second video, we went into these funds in a lot more detail, talking about how you should be using them properly, when you should be buying them, and when you should be selling them. Now, the idea for that second video actually came from questions that I had received down in the comments. And those questions are so unbelievably important for me because they help me to understand how you are interpreting my content. Now, normally when I'm talking about this stuff, I'm sitting down in front of a client in person and I can see their face and I can see how they're reacting to the analogies that I'm using and the way that I'm phrasing things, and when they're getting bored, because there's different ways of explaining things that work better with different types of people. But here, just sitting here in my kitchen, I don't have that feedback. So it's actually very difficult for me to work out exactly how my content is being understood. So firstly, thank you so much for your engagement. And please do continue to write any questions that you have down in the comments. There are no stupid questions. Ultimately, everybody has to learn this stuff at some point. I mean, there was a time quite a long time ago where I was asking exactly the same questions that you are now. And if I didn't ask those questions, then I wouldn't be where I am now. So again, the idea for this video has come from down in the comments from the past 2 videos. And I've had a huge number of questions asking pretty much the same thing. I've invested in a life strategy fund, but how should I be changing this or reducing the risk as I get closer to retirement? Now, of course, Vanguard have actually got a set of funds, their retirement target funds, that actually do all of this for you. So that's what we're going to be talking about today. Firstly, we're going to be looking at how these funds differ from the life strategy funds. I'm then going to be showing you why I think Vanguard have got this wrong. And then finally, we're going to be looking at some better ways that you can think about managing risk as you get closer to retirement. So before we get stuck in, I just want to do a quick recap on what risk is and why it is important, because we're going to be talking about it a lot in this video. Risk can be defined as lots of different things, but in this video, we're going to be using it to describe how volatile we expect an investment portfolio to be. So we would expect that a 100% equity portfolio would be more volatile, would be more risky than one made up entirely of bonds. But with higher risk, we would also expect to get a higher return. So here, if we take a look at the performance of the 5 life strategy funds over the last 10 years, we've got A at the top, which is the 100% equity portfolio, and at the bottom we've got E, which is the 20% equities and 80% bonds, with the other portfolios spread out in between them. Now, as you can see, the higher risk portfolios have produced a higher return, but you can also see that their journey has been a lot more volatile. It's been a lot more up and down. And if we take a closer look at the crash when the pandemic happened last year, we can see how much worse these higher risk funds did actually do. So this is the thing. You can go for a higher risk fund and you should expect to get a higher return over the long term. But in the short term, you're going to see a hell of a lot more volatility. But the bigger risk with these funds is actually you. Because if you pick a fund that is too high risk for you, and then you go through another crash exactly like we had last year, and then you panic and sell out, that is ultimately the worst possible outcome. But if you pick a fund that is too low risk for you, you could end up with lackluster returns, which ultimately ends up with you increasing the risk of you running out of money in retirement. So it's a very delicate balancing act, which you need to get right now. But not just now, you also need to get it right through every single different stage of your life, which is what we're going to be talking about today. So let's get back to comparing the difference between the life strategy funds and these retirement target funds. So both of these funds are known as one decision funds. So once you've picked one of these funds, you do not need to invest in anything else, potentially ever. Now that is how they have been designed to be used, but you don't necessarily have to use them like this. So with the life strategy funds, they have 5 different funds, all of different risk levels. So all you need to do is pick one that is appropriate for you. But the problem is that as you get closer to retirement, you may want to decrease the risk level of your portfolio. Now, that is not actually hard to do in practice because all you need to do is sell one fund and buy back the other, and you can keep it all within whatever ISA or pension that is invested in. The harder question though is when should you do this and what risk level should you change to? So Vanguard have come up with the bright idea of creating a set of funds that does this for you. So Vanguard has created this broad set of funds that are all spaced out by 5 years. And if you wanted to retire in 2055, for instance, you would pick the 2055 fund. It's pretty simple. So once you've selected one of these funds, it will automatically reduce your exposure to equities and increase your exposure to bonds as you get closer to retirement. And you can see how they do that here. Everyone starts off with an 80% equities and 20% bonds portfolio until they are 45. And then they start to decrease the allocation to bonds all the way to 75, where it levels out at 30% equities and 70% bonds. Now, if we compare the 2065 Target Retirement Fund, so that's the furthest one out, that is still at 80% equities and 20% bonds, and we compare that to the Life Strategy 80% equities and 20% bonds, we can see that they are more or less made up of the same stuff. They do have a slightly different fund mix, but the overall global exposure is more or less the same. And if we look back at the last 5 years worth of performance, we can see that they are pretty much identical. So they are pretty much the same thing. The only real difference is that whilst with the life strategy funds, you have to manually change your risk as you get closer to retirement, the retirement target funds do that automatically for you. I've spoken a number of times before about how important it is to keep your investment portfolio simple, which is what life strategy funds are very, very good at doing. But these retirement target funds take that one step further. These are truly one decision funds in that you could invest in one fund and you could never sell out of it for your whole life. But in my opinion, I think Vanguard have taken this one step too far. And I actually think that these funds are only going to be suitable for a very small amount of investors. So let me explain why. In an attempt to make these funds simple, Vanguard have looked at what the average person may need from a risk perspective over their lifetime. So with a higher risk when they're younger and reducing that risk as they get closer to retirement. I mean, it sounds reasonable, right? Well, it is for the average person. But the problem is that very few people are actually average. Most people are above average or below average, and then their position actually changes over time. And in reality, we're all in totally different circumstances that require very different ways of managing risk. For example, there are some people that it makes sense for them to actually just hold all of their money in cash and not bother investing at all. Whereas on the other side, there are some people that can carry on investing at exactly the same risk level throughout their entire lives. People often like to tie risk to age because it's simple and it's easy to understand, which is ultimately the same reason why people quite like these retirement target funds, because they are simple and easy to understand. But in reality, age is just a number and it really doesn't matter as much as you think. So if age doesn't matter, then what does? Well, that's what we're going to be looking at for the rest of this video. We're going to be looking at some of the factors that you need to consider when making these types of decisions, so that when the time comes, you can actually go away and try and apply these to your own position. So the first thing that we're going to look at is your risk tolerance. So this is how comfortable you are with taking risks. So how much volatility could you withstand without panicking? What's really interesting is that your tolerance for risk when it comes to investing actually goes beyond this and applies to other aspects of your life. And what we often find is that people that have got a high risk tolerance when it comes to investing are also in higher risk jobs and are also likely to have higher levels of debt. And this attitude to taking risks actually stays fairly consistent throughout your life. So we use this risk tolerance score sort of as a high watermark beyond which you shouldn't go from a risk perspective. So if we had somebody that was a higher risk investor, let's say 8 out of 10, we may say that the maximum risk that they should ever take is an 80% equity, 20% bond portfolio. But that's just a starting point, because the next thing that we need to consider is how much risk do you need to take to achieve your goals? So your requirement to take risk. Because just think about it. Imagine if you had been an avid saver throughout your life, or maybe you just sold a business and you were sitting on a massive pile of cash, and you'd worked out that you actually had enough cash to sustain your lifestyle for the rest of your life. Well, you don't need to take any risk. So why would you? And it may make sense to actually dial the risk down, or potentially to take no risk at all and just keep your money in cash. But in reality, when you find people that are fortunate enough to be in this situation, they normally do have goals and ambitions for this money that extends beyond themselves. So looking into future generations, or thinking about projects or charities that they might want to support. So although they personally may have no requirement to take risk, the goals that they now have for this money do require growth. And you may find that some of this money actually remains invested at their maximum risk level throughout the rest of their lives. But for most people, the reality is that you're going to get to 60 or 65, whenever it is that you retire, and you're going to be in an okay position. But you're still going to need a hell of a lot of growth over the next 15 to 20 years to ensure that you don't run out of money. But the problem is that if you had invested in one of these retirement target funds, which had automatically reduced your risk down to 30% equities, you may be only seeing a 3 or 4% average annual return per year, which may be too little to achieve your objectives. So instead, all you're doing is dramatically increasing the risk that you're going to run out of money by eating through your savings. So you may find yourself in this position where you obviously have the same risk tolerance as before, and you ultimately have a very similar level of requirement to take risk. So maybe you should just stick with the same asset allocation all the way through. But something has changed, and that's your capacity for loss. Now, capacity for loss means how resilient you are to taking short-term financial knocks. So if the markets were to crash next week, how badly would that affect you? Well, when you're young, market crashes don't really affect you at all, because you don't need this money now. You don't even need it in the next 5 to 10 years. And you've got plenty of time to wait for the markets to come back. And on top of that, you're going to be earning more and more money. And if the markets have crashed, you're going to be investing this at a much lower price than before. It's all good. But if you're about to retire and the markets suddenly crash, you do not have time to wait for them to come back, because you need to start creating an income from this money right now, which means that you have a much lower capacity for loss. So you may need to reduce the risk of your portfolio. But hang on a minute. What if you had got to retirement and then you had worked out how much money you would need to fund your lifestyle for the next 3 to 5 years, and you had taken that money out of your investment portfolio and you'd put it in cash? Well, now you've got that cash buffer as protection. How much do you care about short-term drops in the market? Well, definitely not as much as before. So it might actually make sense for you to maintain a higher level of risk in your portfolio. Now, you do need to look at this as a whole. So if you're going to take a big chunk of cash out of your investment portfolio, that does mean, when you look at it overall, you are taking less risk. But your investment portfolio may be able to chug along at exactly the same risk that it was at before. So I hope you're starting to see that retirement is much more about good cash flow management and ensuring that you're never forced to sell stocks during a downturn than it is about just simply reducing risk as you get older. And although these retirement target funds may be suitable for some people some of the time, they will be unsuitable for anybody that does not fit this exact path. I know some of you have been asking me to provide some more concrete solutions in my videos, so sort of rules and guides that you can just follow and implement yourselves. Well, when it comes to investing, that's actually very simple, and I think you already know my stance on this. All you need to do is invest in a globally diversified portfolio of stocks and bonds, ultimately something similar to these life strategy funds. But when it comes to financial planning, so how much you should be investing, when you should be investing, how much risk you should be taking, and what sort of tax wrappers you should be using, well, the answer is not that clear cut, and it depends very much on your own unique personal circumstances. And today we talked about some of the main factors that you need to consider when making these decisions. But there's also lots of other things that can come into the mix, like how much income you're getting from other sources, whether this money is invested in pensions or ISAs, or whether you've still got debt, which is why I am never going to be able to tell you exactly what you should do. You're going to have to work that out for yourself. I understand that on one side, this video may have answered a load of questions and then just created a whole load more. But I intend to create a lot more content about this stuff and go into a hell of a lot more detail so that ultimately I can give you all of the tools that you need so that you can feel confident making these decisions on your own. So stay tuned.